2024 is wrapping up and the IRS has shaken things up for crypto traders this year. Whether you are a hodler, a trader or just someone who got paid a bit in Bitcoin, the clock is ticking to get your tax game on point before New Year's Eve. In this video we are diving into the must-do moves to tackle the new IRS crypto tax rules like a pro, and maybe even save some cash in the process. Think of it as the ultimate end of the year checklist. The IRS didn't hold back their crypto tax updates, and if you are not in the loop, you might get caught off guard. Here's a quick rundown on the biggest changes for 2025. Per wallet tracking. The IRS now requires detailed reporting for each crypto wallet you use. No more lumping everything together. Each wallet needs its own breakdown. The new Form 1099-DA. If you've been trading on US-based exchanges, expect to receive the new Form 1099-DA. It's designed to simplify reporting your crypto transactions, but it also means the IRS will know exactly what you've been up to. So what does this mean for you? Starting January 1st, 2025, crypto investors can no longer use the universal cost-based allocation method. Instead, you will need to use either the specific unit identification or the global allocation method. This means you need to start preparing now by organizing and allocating any unused cost bases before the new rule kicks in. Neglecting this could lead to a higher tax bill or reporting errors. And here's your advantage. Coin tracking already has per wallet tracking features in place, making the transition much smoother for you. You can activate it by setting the depot separation. For a deeper dive into these changes and how they will impact you, don't miss our video, The New Crypto Tax Rules, what you need to know for 2025. Now that we've covered what's new, let's quickly go over the key taxable events that could apply to your crypto activities. Selling crypto for fiat. For example, converting your Bitcoin or Ethereum or any other cryptocurrency into US dollar triggers a taxable event. Crypto to crypto swaps. Trading one cryptocurrency for another, like swapping ETH for Sol, is also considered a taxable event. Earning crypto. This includes rewards from staking, mining, or even receiving airdrops. They are all considered income at the time you receive them. Using crypto for purchases. If you buy something using crypto, the IRS treats it like selling your crypto at its fair market value. Depending on the type of transaction, you will be subject to capital gains tax, for example for selling or trading. Income tax, for example for earning crypto. This distinction is crucial for organizing your records and preparing your end of the year. Remember, understanding these taxable events is key to staying compliant with IRS rules. If you are unsure about the details, we've got you covered in Crypto Taxes Explained for Beginners, US 2025. Be sure to check out for more examples and tips, the link is in the description. Alright, let's get into the good stuff. What you can still do before the year ends to reduce your tax burden legally. Here are some smart moves to consider. Harvest crypto losses. If you've got cryptos that are underwater, worth less than what you paid for, now might be a good time to sell and realize those losses. These losses can offset your capital gains without a limit and even reduce your taxable income by up to $3,000 if your losses exceed your gains. But just remember, don't rebuy the same asset right away or you will run into the wash sale rule. Offset gains with carryover losses. If you have losses from prior years that you didn't fully use, you can use them now or carry them over to 2025. These carryover losses can help offset this year's gains, lowering your overall tax liability. Use your capital gains tax allowance. Now you can earn up to $47,000 or $94,000 if you're married in long-term capital gains tax-free, if your total income is below this threshold. Check your income bracket and make the most of this allowance before the year ends. Invest in IRAs. If you have sold crypto for a profit this year, consider putting some of that into an IRA. Contributions to traditional IRA may be tax deductible, while a Roth IRA allows for tax-free growth on investments. This is a great way to grow your wealth while reducing your taxable income. Additionally, there are various Bitcoin IRAs available which let you invest directly into cryptocurrency with a tax advantage retirement account. These can be a smart option for long-term crypto holders who want to diversify their retirement portfolio. Use US tax deductions. Beside the standard tax deductions, you should take advantage of other tax deductions available in the US, such as the student loan interest deduction, the health savings account, contributions, or child tax credit deductions. These deductions can help offset your taxable crypto income, and check the official IRS website to explore all available deductions and possibilities to ensure you are maximizing your savings. Gifting crypto. Did you know that you can gift crypto tax-free up to $18,000 per person in 2024? This is a great way to spread the holiday cheer without triggering a taxable event. Plus, you can share your gains with your family and friends. Win-win-win. Optimize your holding strategy. If you are nearing the 1-year mark on a holding, consider waiting until you hit that milestone before selling it. It could save you a lot in taxes. Donation deductions. Donating crypto to a registered charity can lower your taxable income. The donation is valued at the fair market price of the crypto at the time of transfer, and you don't have to pay capital gains on it. So consider this and find a good cause. Track transactions and use crypto tax calculators. Staying organized is half the battle. Coin tracking helps you calculate your gains and losses and even identify tax saving opportunities. Plus, with features like specific unit tracking or global allocation, you will be fully prepped for the 2025 rules. Now is the time to take action and ensure you are set up for a smooth tax season. The earlier you start, the more options you will have to save. Timing is everything when it comes to taxes, and missing a key deadline can lead to penalties or missed opportunities for saving. Here are the critical dates you need to keep in mind for the year 2024. The tax year runs from January 1st to December 31st, and your 2024 crypto taxes will be due at April 15th, 2025. This is both the reporting and the payment deadline. If you file for an extension using the Form 4868, you will have until October 15th, 2025 to submit your tax return. But keep in mind though that the extension only applies for filing. Any payments owed must still be made by April 15th to avoid penalties. If all these changes and deadlines feel a bit overwhelming, don't worry. You don't have to go through it alone. Crypto taxes can feel like navigating a maze, especially with the new IRS rules coming into play. If you are feeling unsure and overwhelmed, don't hesitate to seek professional help. A tax expert familiar with crypto regulations can guide you through the process and help to avoid costly mistakes. Better yet, the coin tracking full service can take care of everything for you. From organizing your transactions to generating an accurate tax report that is ready to file. Our team of crypto tax professionals ensures that you are fully compliant with all IRS rules, including the new cost basis allocation and reporting requirements for 2025. The peace of mind is worth it. And that's a wrap. Taxes might not be exciting, but saving money definitely is. If you want to stay ahead of the game, also check out our other videos. They are linked in the video description. And don't forget to like, subscribe and share this video with anyone who needs some tax wins. Until next time, stay smart, stay compliant and keep those crypto gains growing.